Hello, everyone, and hello to our leading edge clients, leading edge friends. Andy Christopher here. I'm a lead planner with Leading Edge Financial. This is our quarterly market update. We just wrapped up the third quarter of 2024, and this is our second quarterly market update that we've had going forward. So just excited to share what's been going on in the markets, look at some headlines and hopefully kind of bring to life what's happened in our economy and abroad. So let's jump. We'll jump right in. So I think last quarter, if you had an opportunity to watch that presentation, the theme was really about the Magnificent Seven, NVIDIA, Facebook, Amazon, so our US large cap friends here who were really outperforming even the S&P 500. We looked at concentration. The theme this quarter, ending September 30th of this year, is really all asset classes performing really, really strongly. And frankly, other asset classes that we're not used to seeing outperforming the US market doing just that. We saw a 7% return in international developed, 8.7% emerging real estate investment trusts, right? Doing incredibly well, 16% return last quarter. That's really not a surprise when we look at the Federal Reserve in their rate cutting environment. And on the fixed income side of the house, the US bond market last quarter, 5.2%. Again, not a huge surprise in a rate cutting environment when rates go down. That we see that bond prices generally go up. But I think an important takeaway for an investor, right, if you're thinking about how does this impact you, is these are the kinds of quarters that make up for the bad quarters, right? These are many standard deviations away, more than likely, from what the average return is for quarters. And of course, there's a whole quarter to go for this year. But these are pretty strong returns as the Federal Reserve attempts to stick the soft landing. We see an interest rate cut coming into the quarter. So all things we'll talk a little bit more about as we go forward. Okay, moving along, let's just look at the long-term summary again. 35% in the US market over the last year, 25% developed, 26% emerging. Real estate, again, doing quite well even over the last year. And bonds providing 11.5% returns. Again, these are the returns in our portfolios that are over the last year that are quite frankly making up for years of underperformance. The long-term return on the S&P 500, just for context, is about 10%. So certainly don't expect this to be persistent year over year, but take it where you can. This is again just the benefits of being a long-term investor and being in the market across all market conditions, good and the bad. So as we think about what happened over the quarter, there were some interesting times, and I think one call out and what I wrote about was the Japanese stock market suffered its worst day since 1987. We had this interesting phenomenon in early August of what was called the yen carry trade. So that's just taking advantage of interest rates across different currencies. But the yen, the Japanese currency, appreciated about 14% as the Bank of Japan actually raised interest rates. Their central bank raised interest rates, which caused sort of a short-term market panic. And one of the indications of that is the VIX, the CBOE volatility index, sometimes called the fear gauge, actually shot up to its highest level during this time since the COVID-19 pandemic. So at a time when the US economy was essentially shutting down, we had the same level of fear, if you will, in the US markets here in August, and based on really an obscure kind of phenomenon happening. And so again, I'll go back to this just being a long-term, persistent, consistent investor, and someone who was reading the headlines and saying, "Oh my gosh, this is this the COVID drop all over again?" It may react negatively, but as we just saw in the previous slides, the market performance done incredibly well. And of course, we recovered nicely. The S&P 500 was even hitting all-time highs throughout this quarter. So just a little bit of a backdrop here of what was happening in the markets over the last quarter. And of course, we completely forgot about it. No one's even talking about it. And really, we ended the quarter with the big news, which was the Federal Reserve cutting interest rates by 0.5% on their short-term rate. Okay, jumping into the U.S. stock market. So you can see the small value, large value. So value, small cap, all those did incredibly well. 10%, a little over 10, 9, over 9% on small and value. So what's interesting is this is the large growth. This is the Magnificent Seven again that we talked about, which was uh, the darling performer of last quarter. Kind of seen a rotation out of that, and I think this is an important time. Maybe we'll just anchor down on what do we think about at Leading Edge? How do we structure our portfolios? How are we thinking as investors? And we do believe in this small cap and value we call premium. We'll show you that in the next slide. That is academically shown to outperform their counterparts. So small outperforming large cap historically, value outperforming growth historically. That's not always been the case. And in fact, we've seen that's not really always been the case. You can see large growth over a 5-year period, almost 20% versus small value of 9.3%. But we're starting to see where some of those persistent historical returns are manifesting. I think if we just will continue just reinforce that concept a little bit more. This is the size premium. This is historical from 1928 to 23. You can see in the U.S. developed and emerging large has outperformed, small has outperformed large cap. And then this is that value premium across all markets outperforming growth. So again, it's something that all the academics, Nobel laureates, Eugene Fama and Ken French, who actually had the opportunity to see at a conference in Austin, Texas, just a few weeks ago. This is really what they're known for in terms of that size, value, and then profitability premiums. And that hasn't always been the case. We look at small caps, right? If we especially look at the most recent history here, you see the red mean underperformed large cap. That value, kind of a similar story, but really since the global financial crisis of 08 to 2007. And so I think two things, right? One is they can underperform. The other is, and even we, I think as advisors can look at this and say red is bad means negative. It doesn't mean negative. What it means is it's underperformed. But if we kind of go back to that slide we looked at earlier, these 5-year returns of say 9%, large value, almost 11% over 5 years annualized returns. These are returns I would take every day in a diversified portfolio. Of course, if we knew large growth was going to outperform, that would be great. But those are quite frankly dominated by very large companies, making up quite a large percentage of those indices. And so, to me, I look at that as diversification is doing great things for our portfolios. It's still providing strong returns and mitigating risk along the way. Last thing I'll say, if we look at equity returns, we'll look globally. You can see this is the global US kind of right in line. What's also interesting is China had a great quarter, and it continues now even into the fourth quarter. They're up about 23% or so at the end of the last quarter. I think they're around 25% first few days of this quarter. I bring it up, frankly. China has an economy that is drastically different from the U.S., and we all have, I'm sure, opinions on that economy and government structure. But it does show that there are still returns to be had. Number one, in that we call that an emerging market environment, and it's demonstrating that here. And the other part of that is China has a central bank just like the U.S. We have the Federal Reserve as our central bank, and they're doing things to help support that economy. They've lowered their interest rate to 1.5 on their short-term interest rate to 1.5%. reduced the reserve capital requirements that banks are forced to hold, which essentially means that those banks can now lend more money to their to borrowers to help stimulate that economy. It's certainly interesting to see China and Hong Kong right there next to it, everything we've seen in the headlines. Last piece we'll look at before we jump into the fixed income side of the house is our REITs real estate. Been really since COVID, we've been beaten up. That's no surprise there. Some negative numbers still on annualized 3 and 5 year. But as you'd expect, when interest rates go down, especially for any of us who have mortgages, right, we intuitively understand that that means borrowing is less expensive. That's true, especially for real estate developers who use quite a bit of leverage to help fund and provide capital for their investments. But like I said, last quarter in the global ex US about 16, just shy of 16% on US rates, and really the 1 year return you can see even in US rates is 33%, essentially pricing in these interest rate cuts. It's probably worth mentioning at this point as well. We think about real estate, especially REITs. We think, oh my gosh, these are the office buildings that are still vacant in all of our major cities or have very low occupancy. But REITs really do encompass a wide spectrum to data centers, which of course with the AI boom are becoming more and more important. Cell phone towers, warehouses, right? That Amazon uses to make sure I can get to everything I order within the next 2 hours. But so I think there's an important distinction there in terms of what does even makes up a REIT, but I've certainly seen that part of our portfolio do quite well. Let's jump into fixed income again. This was the big story of this quarter. The Federal Reserve cut the interest rate by 0.5%. And just for a level setting, when interest rates go down, that means bond prices go up. So there's an inverse relationship. We really focus on is called this Bloomberg US Aggregate Bond Index. That's essentially the core high quality investment grade holdings across the entire fixed income spectrum, or much of the fixed income spectrum in the US market. So you can see in the next quarter, just over 5% return. We've had a trailing 1 year return, and you can see about 11.5%, which is quite high, frankly, for fixed income. And certainly when we were in this post-global financial crisis, lower for longer zero rate environment, getting those sorts of yields was challenging. We still are feeling the effects despite those returns from 2022 and those interest rate increases that the Federal Reserve undertook to help try and tame inflation. But we're still seeing across various asset classes the 10-year 3.8% yield. So those yields are still providing some level of return above and beyond what we were able to get 3-4 years ago. As we look at the Federal Reserve, this is where that federal funds rate, that's just the short-term interest rate that banks can lend to each other. The Federal Reserve essentially influences that via their federal fund rate and some of the things that the central bank does to manage that. But it was a 0.5% interest rate cut down to 4.75 to 5. Certainly FOMC, the market members of that open market committee on the Federal Reserve predicting some future rate cuts. Maybe we'll see another one in 2024, where that's 0.25%. Certainly expecting 2025 eventually see some more rate cuts as we go. And you can see that long-term protection there about 2.9%, or probably settling out in 3% into 2025, 2026. Of course, that's in today's economy from what we know, and the economy can always change as we've seen in the past. But again, what does this mean for us as an investor? Well, really as a consumer, we mentioned earlier, it means we can borrow at lower rates. If you're looking to go buy a home, mortgage rates theoretically should come down. But as an investor, right, we're used to getting 5% return on cash. Those days are likely gone. as rates are starting to come down. And then the last piece would be like, well, why is the Federal Reserve cutting rates? Why now? Just for context and background, the Fed has really a dual mandate. One of those is inflation, right? And the other is price stability and to maintain full employment. So they feel as though the price stability is getting under control. In other words, inflation is under control. And now the rate cutting environment is meant to ensure that they don't tip the U.S. economy into a recessionary environment, which of course would impact that second part of their mandate, which is full employment, to the extent that a recession would likely cause folks to lose jobs. And so that's where we're seeing the rates are now coming down to keep the economy, keep that engine moving, and keep the goods and products flowing. That keeps our economy strong. And so that's really what we're seeing out of the Federal Reserve. And of course, they'll continue to manage that. On the inflation front, we can see that inflation has come down. You can see from August of 2024, a headline that includes food and energy of 2.6. We look at the core 3.3%. That went down because energy actually went down as a component of inflation. So we've come a long way from the 9% inflation that we were seeing. And ideally, right, in the Federal Reserve, they are targeting a 2% inflation rate. So targeting a little bit lower. And of course, again, they feel as though they've started to get close enough to that target to justify an interest rate cut going forward. So I want to end with what are we doing at Leading Edge as we think about our portfolio? We think it's important to be critical, to always look at how we invest in our clients. What are we doing, and can we make changes that are aligned to our investment philosophy? Of course, we don't believe in market timing. We believe in being persistent investors, low expenses. But we did, over the last several months, take a fairly deep dive into our fixed income portfolio and decided to make just a few changes, kind of at the margins, if you will. So tweaks. Just to give you a little bit of a sense of what you're seeing, we have our conservative and aggressive, just as we think about for our clients who are, say, in a higher equity allocation. And that fixed income is meant to be, always a ballast of the portfolio, but part of the return driver. And you can be, quote, a little more aggressive. Whereas our conservative investors, right, those are folks who are in retirement, they're living off of their portfolio or they're approaching retirement. And now that fixed income is really meant to be income generation and truly a protection part of the portfolio as their time horizon is much shorter. So a couple of big things, right? I'll just mention briefly. We've looked at, just like I mentioned, hey, for an investor, put in money in a savings account, right? So the T-bills rates are coming down. We'll look to still be in a similar short duration environment for that portion of our portfolio, but variable credit type exposure that looks to just enhance yields again while still being in high quality investment grade. We rotated our core aggregate bond holding into one of our investment providers, Dimensional, into their core fixed income. What does that mean? Well, it's still going to track this U.S. aggregate bond index, which is what we looked at earlier. And again, investment grade, high quality bonds, but it'll do so in that just like size and value or academic principles, do so on a fixed income academic principle. In other words, as the spread between government and credit increases or decreases, and as the spread between long-term and short-term increases or decreases, that informs the future expected return of the fixed income holdings that we have in our portfolios. And so using that partner, Dimensional, allows us to be flexible in this current economic environment. Again, while still thinking about, what is our philosophy on fixed income, right? Well, it's to protect our clients' assets that they've hard earned and saved, but doing so in a way that hopefully we can achieve ever so slightly higher returns and do that in a disciplined and academic setting. The last piece we decided was we removed the high yield portion from our portfolio. So these are sometimes called junk bonds. below investment grade. It was a small portion of our portfolio, and we really thought about, again, what is the investment philosophy that we have, and decided that, the additional diversification benefit of the high yield space didn't outweigh the increased risk from maybe higher default rates that we may see or have seen historically in the high yield sector. And so because of that, made the decision we'll remove that entirely from the portfolio. Despite that, high yield has done great over the last year, up about 15.7%. And so I think it's important to note, as we think about, when do we make decisions for our clients' portfolios, the same thing we talk to our clients about is, let's make decisions because it makes sense for us and not because the market is dictating what we do. And certainly that was one of our considerations. We thought about that fixed income allocation within the portfolio. So I'll end there. I hopefully you get a sense of some of the macro trends in our economy, in our markets over quarter. Strong quarter. We've made some changes to our portfolio. You may see some extra rebalancing in the portfolio. But really, if you have any questions, I encourage you to reach out to your lead advisor. You can always reach out directly to me if you have any questions about anything that was discussed today. I'm Andrew at leadingedgeplanning.com. Thank you for your time. Take care.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.